Good day, fellow investors. Are we in a stock market bubble, and will this be called the 2021 stock market bubble? Well, if we look at the data, it all depends whether the bubble will burst. Because if you define a bubble, it has to burst to become a bubble. We never heard of a bubble that went up in prices or whatever, but didn't consequently burst. And this is a nice list of bubbles in the past, and you can see declines from 90, 60, 50, 70, all huge declines. We have seen gold going down 44%, Japan real estate 76%, copper 66%, uranium 70%, oil 70%, China shares 71% down, and the average bubble decline is 71%. 80-year-old investors, 90-year-old investors say we are in a bubble, and that's what we are going to discuss, because if we are in a bubble, it means it will pop sooner or later, which also means 70% down, and 70%, 80, 90% down is something important from an investing perspective. But maybe, just maybe, this time it's different. So to discuss stock market bubbles, let's first define what a market bubble is. An investment operation is one which, upon thorough analysis, promises safety of principal and a satisfactory return. That's investing. Analysis, risk, and return. Everything else is speculation. If safety of principal and satisfactory return are included in the current market, then it's not a bubble. If not, then it is a bubble. We are going to go through 7 key bubble factors that will give you an indication of what pockets of the market are in a bubble, what not, and where to put your money depending on your financial goals. After all, it's all about you. If you like this video, please click that like button, and if you haven't, consider subscribing. Thank you. So let's start with the 7 key bubble factors. The first one is exuberance. A few days ago, ARK announced or filed for a space exploration ETF, and all space stocks exploded. Virgin Galactic stock just rumors, and then boom, 32% up in 3 days just on rumors and speculation of, what is this, a ETF concert on space. Investing would be getting dividends from Mars. Maybe it will come, maybe not. Perhaps this time is different. Another stock showing a lot of exuberance is Airbnb. First, the IPO was at what, 60, and then the next day, after professional investors got the stock at 60, everybody else in the market is happy to pay, what was it, 140, and now, just, what is this, a month later, everybody's happy to pay even more, 30% higher than that, for a 108 billion market capitalization. Please let me know in the comments what is the revenue and what are the profits. Not to bother you with more stocks that have exploded, this is the ludicrous index. So all companies that have more than a 500 million market capitalization, price to sales bigger than 10x, and have doubled or more in the past 3 months. So we are really a lot of companies, but still far away from the February 2000 peak of the dot-com bubble. So one could think there is plenty more of money to be made. And when you see all these stocks explode on the upside, the second factor describing a bubble is chasing performance. Everything is about performance, not about investing and reaching a return. It's just about being better than the other guy. I recently listened to a Bloomberg interview with Howard Marks, and Eric, the Bloomberg guy, asked, well, we have seen value stocks, the Russell 1000, go up 300% in the last 10 years, but the Russell 1000 growth went up 500%. So if somebody invested 100,000 in 2010 in value stocks, he would now have 300,000. But that's not good. 3 times your money is not good because some other option brought 5 times your money. So everyone is chasing performance, which is a fundamental factor for bubbles. It's not about valuations, it's not about risk, just chasing performance. And it's very dangerous, but so easy to get into that game of forgetting everything else except the stock price. All stock prices going up, and if you are underperforming, then you start getting fear of missing out. And this is a chart from the Norwegian stock market, the provider there, and look at the COVID explosion in investing. The number of investors in Norway exploded. The most traded stock, Norwegian Air Shuttle, because going up and has the most potential. But the situation hasn't been as profitable as many of those expected. But that's just Norway. I went onto YouTube and I typed in stocks to buy and I checked what is coming out. This is insane. Best stocks for 10x your money. Crazy. 500% upside. Buy these high growth stocks and look at the views. 500,000 views in just 2 weeks. 100,000 views. And I was happy with my 20,000-30,000 views. Now that I see this is insane. 10x your money. I'm buying these massive growth stocks, huge gains, Tattooed Chef, Ocean Power Technologies. This stock is about to blast off. I just bought this stock, whatever ARK is buying. 100x growth, multi-bagger stocks, 10x return potential. This is really insane. But that's the fear of missing out, and if something goes up, then nothing else matters. Valuations also don't matter. Just look at Amazon. The price-earnings ratio was always high, and look at what it delivered to investors. And then, of course, these stocks go up on the hope or certainty that these prices will grow into their valuations. If we look at fundamentals, fundamentals don't matter. The Shiller price-earnings ratio is at the second highest level in history, also higher than 1929. This means that when it is at 30, that long-term 10 to 15 year returns will be between 0 and 5%, but as long as the market keeps going up, Sven, what are you talking about 0% 15 years? I want to make 100% in the next year, 2 years. Tesla will go up double, quadruple in the next 10 years. Don't be ridiculous, Sven. If we look at valuations, this is interesting because at all the top bubbles where we have seen crashes, we are now relatively higher than anything in the past, trailing price-earnings ratios, but also bubbles have popped with, or markets have crashed with much lower valuations. So also valuations don't matter for the downside. This indicator, S&P 500 stock market capitalization, highest in the last 50 years. The S&P 500 makes 150% on the US GDP. With GDP growing at 2%, with the best estimations, stocks will grow faster because, again, this time is different. And this is very interesting. S&P market capitalization as part of world GDP is, again, huge as it was in 2002. This is also telling you about where to invest in the bubble or not elsewhere in the world. And of course, earnings don't matter at all. If we look at the S&P 500, the earnings line, which we'll discuss in the upcoming educational videos, and we look at the stock prices, you see a discrepancy here in the 2000s as stocks went up in exuberance, but over the long term, stocks follow this earnings line, and this is the tax benefit, the lower corporate taxes that have impacted earnings, but stocks have really diverged from earnings on zero interest rates. Over the very long term, this is the key to follow, but this also signals, if it bursts, that we are in a bubble. If it doesn't burst, then of course it won't ever be a bubble. We can see low long-term returns where those earnings catch up with valuations over time. We'll see. The next factor for this divergence in stock prices and earnings, there must be something underlying fueling this exuberance and this flow into risky assets. And in this case, we have the Fed. It all started, of course, already in 2009 after the financial crisis, was increased in 2012, 2013, then a contraction. We have seen also the market going down, but then as the Fed has to save the market, also with repo interventions prior to the COVID crisis, they started printing money again and injecting liquidity in the market. This Fed's action is what is protecting the market and fueling the bubble, if it is a bubble. If we look at how the Fed is doing and forecasted, it's that there will be more and more money going into the market. Not only the Fed, also the Bank of Japan, ECB, and Bank of England will keep pushing money into the market to save their economies, to keep adding liquidity to the financial markets, which they believe are the key to economy, to spending, to everything. And of course, on low interest rates, cuts are always bigger than hikes, because we are there in the debt cycle. And here we are with zero interest rates for already 10 years. We have seen a tentative increase in rates, but boom, we are back down, and this is what is fueling this current stock market situation. Low rates and extremely high liquidity. And if you look at what the FANG stocks did over the last years, look at how the FANG behaved and compare that to the major 5 central bank assets. So I would say this is pretty much in correlation, and therefore also it explains part of the market. Plus, these days you have stimulus checks that come into the mail so that you can buy more and more stocks. And all these people getting into the market, and there are no risk warnings. Nobody is telling about the risks of speculating versus investing. Because if we look at retail traders, we have seen an explosion as the COVID checks and stimulus and people being at home, at casinos closed, really explosion in retail trades, and all these IPOs going public now through various financial engineering schemes, from SPACs. If we look at the age of the IPOs that came to market in 2020, those are really the youngest since prior to stock market crisis. So these are all companies that have been alive for 5 years, and they try to go public as quickly as possible because there is where the money is when you go public. So entering the market, things that would be only allowed for sophisticated investors, now everyone with an app, with 2 fingers, with 1 button can buy, and then magic should happen. Is happening as we are looking at all the performances out there of these stocks. And if we summarize this with Goldman, we have the largest inflow of stocks ever, very positive sentiment at the moment, lowest short interest as nobody is crazy to go against the Fed, and percent of respondents who believe the next move is up is going up, up, and up. So the stock market can only go up because this time is different. On specific assets, we have seen the bubble in Bitcoin. It popped, and now we are seeing the bubble in Bitcoin in Ethereum again. Whether it will pop or not, I don't know. This is also what's fueling the bubble. Perhaps this time is really different, and we will shift from what we have done over the last 2000 years into some new environment. It is possible, and just saying that it is possible, fear of missing out and everything might keep fueling this bubble for the next year, 2 years. There is the Fed. As soon as there is less liquidity in the market, boom, the Fed fills every liquidity gap, similarly in Europe. So there is so much money, and that money is going everywhere. So the most rational thing to do would be just to follow the trends and bet for the next year, 2 years, take those rides up and enjoy life. If we look at NEO stock, this has exploded, what? 1,200% since May 2020. So really a lot of such stocks in exuberance exploding, and you just need to find the next one and you make 10 times your money. But a bear market will come. And what will trigger it? Well, my assumption would be that interest rates and inflation are going to trigger a bear market. Because we have seen how the Fed is printing money, pushing money into the system, bringing liquidity. But at some point, it will not be able to do this because of inflation. But of course, nobody knows when will this happen. Will it be some other external factor, internal factor, something that happens that shakes the market, I don't know. What I know is that I will be missing out on these extreme gains on these speculative stocks. And you might call me crazy, but I want to show you something. Because bubbles here and there, those burst. And when that happens, then you are in trouble as an investor, because there is nothing to hold on to when that exuberant bubble bursts. So yes, I'll be happy to miss out on the stocks we have seen 1,000 times up, 10 times up, huge growth. I'm very happy with my 50% that I did over the last 2 years, the 50% that I did over the previous years, the 200% that I did over the previous years from that. And that's the key, and that's why I'm happy with sticking to investing compared to speculating. Because with speculating, you are here and there wiped out. What I want to do is to invest and to think about principal safety and at a satisfactory return, because that is what I can keep doing over the next 50 years. And that's what investors do, and that's why you always hear about investors in the news or something like that. Very little about speculators. How many dot-com bubble geniuses are you hearing about now or something like that? So that's investing versus speculating. If you want to play the speculative game for another year, 2 years, be your guest. But keep in mind the risks and adjust those risks to where you are in the current life investing cycle. It's all different for everybody. I'll keep looking at emerging markets that are much cheaper compared to US markets. There is also US cheap, so we'll discuss that by discussing grocery stocks. Tomorrow in a video I'll talk about the European stock on Monday. So if you like this investing, safety of principle and satisfactory return constantly over the next 10, 20, 30, 50 years, then click that like button and subscribe to this channel. Thank you for watching, and I'll see you tomorrow.